Hi there. In this video, we explain how inheritance tax works for blended families, including second marriages, stepchildren, and trusts.
Hello and welcome. At Pro Tax Accountant, we get asked a lot of questions, and one that comes up time and time again is this. How do you handle inheritance tax planning when you have a blended family? We're talking about everything from second marriages and stepchildren to the trusts you really need to understand to protect the people you care about. So let's dive right in.
I want to start with a number for you. £130,000. Now that's not a lottery win. That is the amount of extra tax your family could end up paying, all because of one very common, very simple mistake. It's basically the 40% tax hit on a full $325,000 tax-free allowance that can get completely wiped out in second marriages. We're going to show you exactly how that can happen, and more importantly, how you can stop it. So here's what we've got on the agenda for this explainer. We'll kick things off with those common mistakes, then we'll get to grips with the basic tax rules. From there, we'll uncover a really nasty trap called sideways disinheritance. And then, of course, we'll get to the solutions, how to use trusts, unlock some pretty clever tax strategies, and finally, we'll wrap it all up with a clear action plan that you can take away.
Okay, let's start with the heart of the problem. There are over 781,000 step families in the UK. That's a huge number of families whose modern structure often clashes with an inheritance tax system that, let's be honest, was designed for a much simpler time. And the single biggest risk they face? It's a concept called sideways disinheritance.
So what exactly is sideways disinheritance? Well, it's a truly awful situation where, even with the best intentions in the world, your hard-earned assets, like your family home, pass to your new spouse. They might then remarry, or maybe just change their will, and suddenly those assets end up with their family, completely bypassing your own children. It's almost always an accident, but the outcome is absolutely devastating.
Right, to really get why this happens, we need to quickly go over the basic rules of the game. Inheritance tax, or IHT as it's known. These are the fundamental allowances that everyone in the UK has to work with. Let's take a look at the key numbers.
Now, the way these numbers stack up is really important. Every single person gets a £325,000 tax-free allowance called the nil rate band. On top of that, there's an extra £175,000 allowance for your main home, but only if you pass it to your direct descendants. So that's £500,000 tax-free for one person. And here's the key part. These allowances can be passed between spouses. So a couple together can potentially pass on up to £1 million completely tax-free. The catch? You see it there? These figures are frozen until 2031, which means rising inflation is pushing more and more people into paying this tax every year.
So who actually counts as a direct descendant to unlock that extra £175,000 allowance? Well, the definition is surprisingly modern and inclusive, which is great news. It's not just your biological children and grandchildren. Crucially, for blended families, it also includes stepchildren, adopted children, and even foster children. This is a really vital piece of good news.
But there's a catch you need to know about. That really valuable residence allowance isn't guaranteed. If your own personal estate tips over the £2 million mark, that allowance starts to shrink. It actually reduces by £1 for every £2 your estate is over that limit. For larger estates, this relief can vanish altogether pretty quickly.
Okay, now we know the rules, let's look at the trap itself. This is where we see how perfectly normal, standard legal setups can lead directly to that heartbreaking disinheritance we talked about earlier.
It all starts with something that sounds really simple: how you own your home. Most couples own their property as joint tenants. This means you both own 100% of it together, and when one of you passes away, the house automatically goes to the survivor. The crucial bit here is that your will is completely irrelevant. The alternative is tenants in common, where you each own a specific share, and this difference is absolutely critical, because as tenants in common, your will, and only your will, gets to decide what happens to your share.
So, let's walk through this chain reaction. Step 1. You and your spouse own your home as joint tenants. Step 2. You pass away, and because you're joint tenants, your spouse automatically gets the entire property. Step 3. Some years later, your spouse remarries. Now, under UK law, the act of marrying automatically cancels any will they already had. Step 4. If they then pass away without making a new will, the strict rules of intestacy take over, and those rules say the assets go to their new spouse and that family. And what about your children from your first marriage? They get absolutely nothing.
So what can you do? Well, here is our clear, actionable, professional tip for you.
changing the ownership of your home from joint tenants to tenants in common is the essential first step. It's a legal process, but it's straightforward. And what it does is give your will back the power over your share of the property. It breaks that automatic chain reaction right at the start.
And that brings us perfectly to the next step, the solutions. See, once your will is back in control, you need to put the right tools inside that will to protect everyone you love. And the best tool we have for getting that balance of fairness and security right is a trust.
Now, you'll mainly come across two types. The most common for this sort of situation is a life interest trust. It's a brilliant solution. You can leave your share of the house in trust, which gives your surviving spouse the legal right to live in that home for the rest of their life, so they're safe and secure. But, and this is key, they never actually own the capital. When they pass away, your share of the house automatically goes directly to your children, just as you wanted. The other option, a discretionary trust, is a bit more flexible. It gives your trustees the power to decide how assets are shared out among a group of beneficiaries, which can be really useful for more complex family needs.
Okay, now for something a little more advanced. This is where getting proper professional advice can really pay off by showing you how to unlock tax allowances most people don't even realize are there. This is aimed specifically at anyone who has been widowed and has since remarried.
So let me ask you this. How could you accidentally throw away a £325,000 tax-free allowance? An allowance from your first deceased spouse that could save your children £130,000 in tax. Let's walk through how easily this can happen.
Let's create a quick scenario. Meet Jane. Her first husband, Alan, passed away, leaving everything to her. Because transfers between spouses are always tax-free, she didn't just inherit his assets, she also inherited his unused £325,000 nil rate band. So Jane now holds her own allowance and Alan's. A few years down the line, Jane marries Bob.
Now here is the mistake. Jane makes a simple, standard will, leaving everything she has to Bob. When Jane passes away, Bob inherits her estate. But, and this is the crucial part, the law says an individual can only benefit from their own nil rate band, plus a maximum of one other transferred one. So Bob gets his own allowance and he can claim Jane's. But what about Alan's allowance? It's been overwritten. It cannot be passed on a second time. It is vanished. And with it, a potential tax saving of £130,000 is gone forever.
But here is the really elegant solution. In her will, Jane should make a specific gift, a legacy, of £325,000 directly to her own children. Because this gift is taxable, it immediately uses up Alan's transferred nil rate band. It's a case of use it so you don't lose it. The rest of her estate can then pass to Bob completely tax-free, and when Bob eventually dies, his estate can still claim Jane's nil rate band. By making that one strategic gift, the family gets to benefit from all three allowances, Alan's, Jane's, and Bob's. It's an absolute game changer.
Phew, okay, we have covered a lot of ground. We've looked at the problems, the tools, the advanced strategies. So let's pull all of this together now into a clear, simple action plan that will empower you to go and protect your blended family.
Here is your best practice checklist. Number 1. If you are in a blended family, you need to revise your will. Relying on an old one is just too big a risk. Number 2. Check how you own your property, and in almost every case, you'll want to change it to tenants in common. 3. Use the right kind of trust in your will to protect both your new spouse and your children. 4. Make sure you are optimizing every single tax allowance available, especially if you've been widowed before. And finally, number 5, and this is so important, this is not a DIY job. You have to seek professional advice to create a plan that is built specifically for your family's unique situation.
If there is just one single thing you take away from this explainer today, please let it be this. A standard, off-the-shelf, simple will that just leaves everything to your spouse is almost never the right solution for a blended family. It leaves your own children incredibly vulnerable and can waste tens or even hundreds of thousands of pounds in unnecessary tax. You absolutely must have a proper plan.
And now for the formal bit. Please do remember that this explainer is for general information only. It isn't and can't be formal legal or financial advice. The tax rules are incredibly complicated and they do change, so it is absolutely essential that you seek out professional advice that's tailored to your personal circumstances.
Protecting your family's future is one of the most important things you'll ever do. If anything we've talked about today has struck a chord, please don't hesitate to get in touch with us here at Pro Tax Accountant. You can give us a call on 07985 689 912 or drop an email to info@protaxaccountant.co.uk. And for more explainers just like this one, please make sure you subscribe to the Pro Tax Accountant YouTube channel. Thank you so much for watching.